Welcome to a 20-year case study that pits real estate against index funds. Imagine two friends, Alex and David, both starting with the same savings, salary, and ambition. Their only difference: Alex buys a rental property while David invests in index funds. Each believes they've made the smarter choice, but as we'll see, the real answer is more complex. Over the next few scenes, we'll break down their journeys, the numbers, and the hidden costs that can make or break your financial future. Let's set the stage for a fair and eye-opening comparison. Alex and David are financial twins. Both have $50,000 saved, earn $55,000 a year, and live in the same city. The only thing that sets them apart is what they do with their savings. Alex puts his $50,000 down on a rental property, while David invests his in a total stock market index fund. This fair starting point ensures that what follows is a true apples-to-apples comparison, helping us see how different investment choices play out over time. Alex uses his $50,000 as a 20% down payment on a $250,000 rental property. He secures a 30-year mortgage at 7% interest, which means monthly payments of $1,330. He quickly finds a tenant willing to pay $1,800 a month in rent. On paper, Alex is making $470 a month before any other expenses. He feels like he's made a genius move, leveraging the bank's money to build wealth and enjoying the pride of property ownership. David, on the other hand, puts his $50,000 into a total stock market index fund. He doesn't use leverage, doesn't deal with tenants, and doesn't have to manage anything. He sets up an automatic contribution of $300 a month and lets the market do the work. There's no story to tell at parties, but there's also no stress or late-night phone calls. David's approach is simple, quiet, and hands-off. In the first 3 years, Alex enjoys the landlord lifestyle. He collects rent, claims tax deductions, and watches his equity grow. Meanwhile, David's portfolio quietly grows with each contribution, but there's little excitement. On the surface, Alex appears to be winning. He has a house, a story, and visible progress. David just sees numbers on a screen with minor fluctuations, but the real story is just beginning. Alex's rental property isn't all profit. Vacancy means the property sits empty about 1 month per year, costing a full mortgage payment with no income. Maintenance and repairs eat up 1–2% of the property value annually, and big-ticket items like HVAC replacements can hit hard. Capital expenditures for roofs or furnaces are inevitable, and property management either costs money or Alex's free time. Bad tenants can lead to costly evictions, wiping out a year's profit. These hidden costs quickly shrink Alex's cash flow. After accounting for all real costs, Alex's actual net cash flow over 3 years is just $2,000 to $4,000. This doesn't even include the hours he spent managing the property. Meanwhile, David's portfolio, with his steady $300 monthly contributions, has grown to about $76,000. He spent 0 hours managing his investment. The numbers are closer than they first appeared, and the value of time becomes clear. Despite the costs, Alex still benefits from leverage. His property appreciates at 3–4% per year, and his equity has grown to $55,000 to $65,000 by year 3. This is real wealth built with the bank's money, not just his own. Leverage can accelerate gains, but it also concentrates risk in a single asset and location. It's a double-edged sword that can amplify both wins and losses. David's index fund portfolio grows steadily, thanks to compounding and regular contributions. By year 3, he's sitting at $76,000, all without lifting a finger. There's no drama, no emergencies, and no unexpected bills. His investment is diversified across the global market, reducing risk and volatility compared to owning a single property. The simplicity of his approach is its biggest strength. By year 10, Alex's property is worth around $335,000 to $350,000. His equity has grown to $170,000 to $184,000, but he's also spent $20,000 to $35,000 out of pocket on repairs, vacancies, and capital expenditures. David's portfolio, meanwhile, is worth $165,000 to $180,000, with $86,000 of that coming from his own contributions. The rest is pure compound growth. At this point, their total wealth is surprisingly close. Alex's wealth is concentrated in a single property in one zip code. This means his risk isn't diversified. If the local market suffers, so does his investment. He's also spent hundreds of hours managing the property, handling repairs, and dealing with tenants. David, on the other hand, is globally diversified and hasn't lost a single weekend to property management. The difference in effort and risk is becoming clear. At the 20-year mark, the numbers tell the full story. Alex's house is worth $450,000 to $500,000, and his equity is $400,000 to $500,000, plus $40,000 to $80,000 in cash flow. David's portfolio is worth $420,000 to $460,000, all liquid and accessible. Both started with $50,000, but Alex's path required time, sweat, and stress, while David's required patience and discipline. Their net worths are in the same ballpark, but the journey was very different. Alex's wealth came with a price: time, stress, and constant reinvestment. Scaling up means taking on new mortgages and doubling the workload. David's approach was simple. He set up automatic contributions and let compounding do the heavy lifting. If David had increased his monthly contribution to $500, his portfolio would have reached $550,000 to $600,000, all without extra effort. What if David had contributed more each month? With just $500 a month, his portfolio would have outpaced Alex's real estate wealth, reaching up to $600,000. This highlights the power of consistent investing and the impact of small changes over decades. The path to wealth isn't just about the asset, it's about the habits and decisions along the way. Index funds aren't a risk-free path. Market volatility can be gut-wrenching. Watching a $150,000 portfolio drop to $95,000 in a market crash is tough. Many investors panic and sell at the worst time. Index funds also don't provide monthly cash flow. A 2% dividend yield on $150,000 is just $200 a month. There's no leverage and no special tax shelters like real estate offers. Real estate shines in certain situations. Strong rent-to-price ratios, treating the property like a true business, and using strategies like house hacking or 1031 exchanges can snowball wealth. Real estate also offers legal tax shelters through depreciation, something stock investors can't access. When managed well, real estate can provide both cash flow and appreciation. The real trap isn't choosing real estate or stocks, it's picking one based on a catchy headline or someone else's story. Both Alex and David thought they made the smart play, but neither fully considered the true costs in dollars, time, stress, and risk. The best investment is the one that fits your life, your goals, and your willingness to put in the work. One of the biggest differences between Alex and David's paths is time. Alex spent weekends, evenings, and countless hours managing his property, handling repairs, and dealing with tenants. David, meanwhile, spent almost no time on his investments. When comparing returns, it's crucial to factor in the value of your time, not just the dollars on paper. Managing real estate can be stressful. Late-night calls, emergency repairs, and difficult tenants are part of the package. For some, this is manageable or even enjoyable. For others, it's a deal-breaker. Index fund investing, on the other hand, is nearly stress-free. Set it and forget it. Your investment style should match your tolerance for stress and your desired lifestyle. David's index fund portfolio is liquid. He can access his money quickly if needed. Alex's wealth is tied up in real estate, which can take months to sell and convert to cash. Liquidity is an often overlooked factor that can make a big difference in emergencies or when opportunities arise. David's index funds are diversified across thousands of companies and countries, reducing the risk of any single failure. Alex's investment is concentrated in one property, in one location. Diversification is a key principle of investing, and it's easier to achieve with index funds than with real estate. Compounding is the silent engine behind David's wealth. By reinvesting dividends and making regular contributions, his portfolio grows faster over time. The earlier you start, the more powerful compounding becomes. Real estate also compounds, but with more hands-on effort and risk. Real estate offers unique tax advantages, like depreciation and the ability to defer taxes through 1031 exchanges. These can significantly boost after-tax returns. Index funds, while tax-efficient, don't offer the same level of tax sheltering. Understanding the tax implications of each investment is crucial for maximizing your wealth. Scaling a real estate portfolio means taking on more debt, more properties, and more management headaches. Each new property adds complexity and risk. Index funds, on the other hand, scale effortlessly. Just increase your contributions and let the market do the work. Consider your appetite for complexity before choosing your path. Both paths have emotional ups and downs. Real estate comes with the stress of repairs and tenant issues, while stocks can test your nerves during market crashes. Emotional resilience is a key part of long-term investing success, no matter which path you choose. Every hour Alex spends managing his property is an hour he can't spend elsewhere, on work, hobbies, or with family. David's hands-off approach frees up his time for other pursuits. Opportunity cost isn't always obvious, but it's a real part of the investment equation. Your ideal investment depends on your risk tolerance. If you're comfortable with leverage and hands-on management, real estate might suit you. If you prefer diversification and minimal involvement, index funds are a better fit. There's no one-size-fits-all answer. Know yourself before you choose. Both paths require patience. Real estate takes time to build equity and cash flow, while index funds need years of compounding to show significant results. The biggest gains come to those who stay the course and avoid knee-jerk reactions to short-term setbacks. After 20 years, Alex and David end up with similar net worths, but their journeys couldn't be more different. Real estate offers leverage, cash flow, and tax benefits, but demands time and effort. Index funds provide diversification, liquidity, and simplicity, but lack cash flow and can be volatile. The best choice depends on your goals, lifestyle, and willingness to work. The real lesson isn't that real estate or index funds are better. It's that you need to run the numbers for your own situation. Don't rely on headlines or someone else's story. Consider all the costs, risks, and time involved. The smartest investment is the one that aligns with your life and your values. Make your choice with eyes wide open.